Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks, where we want to meet you where you are financially and offer you financial information that can help you stick to your budget, manage to pay off your debt, and begin to save and invest on your journey to building wealth. Today, I'm going to talk to you a little bit about how you can look at your investments to evaluate for your financial independence and the factors that kind of go into that thought process. If this is your first time joining me here on the channel, go ahead and hit that subscribe button and you'll be notified every time I upload a new video. So there are many things that you need to consider when thinking about retirement and thinking about your financial independence number. And I know sometimes it can get kind of exhaustive with all these different little minute details. But I do want you to understand why someone thinks this way and how you can start to evaluate, hey, when am I actually wealthy enough to do something? So without further ado, let's get into the video. The first thing I want you to understand is the general rule of 4%. Now, if you speak to a financial advisor, financial planner, financial coach, any of the biggest thing that they're looking at when they look at your investments and when you tell them, hey, I want to retire and I want to have $40,000, $50,000 a year, things of that nature. The rule of 4% basically states that if you withdraw 4% of your investments to live on, you will never seem to run out of money, or it's very unlikely that you will run out of money. The rule of 4% actually comes back to a study done by William Bengen. I think that's how you pronounce his name. It's very difficult. But basically, this gentleman did a 50-year study in 1994 over a 50-year long period that studied the downturns of the stock market. Now we know the stock market will go up some years and will go down. That's just the ride of the stock market. But William actually concluded that 4% of your total investment nest egg is a safe withdrawal rate that will have the highest chance of you never running out of money for your life expectancy. So suffice it to say, if you had $1 million nest egg, you could simply withdraw $40,000 a year every year for you to live comfortably, and you will never run out of money. This is very big for you to understand. How do people actually reach their FIRE numbers and things of that nature? A lot of them are concluding or making their decisions based off the ability to withdraw 4% to pay for their bills and lifestyle going forward. So when you think about $40,000 a year, maybe you don't have a house payment or things of that nature, but that's why the question really comes in, what kind of life do you want to live? What kind of options do you want to have? So the ideal number right now for most people is $2 million. When you think about 4%, it's $80,000 a year. Very, very good income, and that gives you a lot of flexibility for most people. But that's why I say personal finance is just that, personal. So you have to understand what is going to make you very happy and how can you get to that number. The second piece that brings me to this 4% rule is the fact of the structure matters. So when you think about, hey, I'm withdrawing 4%, $40,000, $80,000 a year, well, a lot of people are putting money into what's called traditional IRA 401k accounts. And that's why I harp so hard and try to encourage you to use that Roth 401k option, use that Roth IRA option, even open a brokerage account option, because these are vehicles that when you have all that money sitting in those accounts, you will have less tax implication. Again, if I have to remind you, I really want to remind you, when you think about investing, it's about how much you can make, but it's also about being tax efficient. And that rule of being tax efficient matters whether you're in real estate, whether you're in business, and especially matters whether you're investing into the stock market. So it's really understanding how can you grow your money over time, and then once you get to retirement, what is going to provide you the simplest way to withdraw that money. Now, I just want to spend a little bit more time here just to give you a better example of what this looks like. So if you have 3 buckets, $3 million nest egg, and one account is traditional, meaning it came from old 401k matches or before you got smart and started putting your money into a Roth. So you have $1 million grown in there. Then a second account where the Roth, where it's completely tax-free, but you have another $1 million in there. And then a third account, maybe it's an after-tax account you've been building up, a brokerage account. Well, then there's $1 million in there. Well, we know automatically you can withdraw the money from the tax-free account, the Roth account. But what does this look like for your tax scenario? So if you withdraw $25,000 from your traditional account, $25,000 from your Roth account, and $25,000 from your brokerage account, you would effectively be paying the most taxes on the $25,000 from your traditional account. The reason for that is from the traditional account, that $25,000 is subject to the tax rate. And if you're just using that income, $25,000 would be your total income for the year. So that's probably one of the lowest tax rates on the income stream. Then you have $25,000 from your Roth. Well, that $25,000 is actually tax-free. So you don't have to do anything about that money. And then lastly, you have $25,000 that you may have pulled out from your brokerage account. And that $25,000 would be subject to potential capital gains tax, which can range about 10 to 15%. So the real money that you actually were taxed on off $75,000 that you pulled out was $50,000. This is why it's very, very important that you understand what accounts you're putting your money into right now, because it's going to affect your long-term play and the decisions of how you get to your money. And that's the importance of having a good CPA in your pocket. That's the importance of having a good financial coach, good financial advisor, those individuals in your pocket, because you don't want to have to think about those things, that structure on your way. The next thing I want you to really think about and call into question is how much you're spending on your debt, your consumer loans, your credit cards, your auto loans, things of that nature. The reason why is because when you realize the impact of what a $400 and $500 car payment actually can do for you from an investing standpoint or savings standpoint, not just in the stock market, but maybe you want to buy a property or whatever the case may be, you will realize, hey, I lose a lot of money paying for credit cards and cars and personal loans and things of that nature. And it's not the fact that I don't want you to have a nice car. It's not the fact that I don't want you to have clothes and trips or do the things that you want to do to enjoy your life. I just want you to do those things in a structure that allows you not to sacrifice your future for that present buy. So it's really important that when you're resetting all this focus, yeah, it looks intense. Yeah, it looks, oh man, I got to pay off this debt, or oh, I got to get rid of this car payment. But you're doing that to set a new program in place where you can actually spend and save and invest going forward. So that's the impact of what you do when you actually look at the fact of, hey, I got credit card bills. Hey, I got car loan bills. These are things that I can actually, this is actually money that I can be using to put away my future. And I also can be still enjoying my life without having any type of financial impact. Whatever life you want to design, you can have, but you do need to start today. And then the last thing I want you to consider is understanding that looking at how you save. In the previous video I did when I talked about kids' savings and the power of starting early and what time and compound interest can do for you, I simply stated that, hey, if you put $200 a month away in an S&P 500 that returned over the past 50 years 11%, and you did that for 18 years, you would unravel about $126,000, over $126,000. You only really invested $43,000. That's an excellent return on your investment. But is really understanding, hey, not that I only want to put $200 a month. It's just, hey, what does that look like with $500 a month? What does that look like if I don't put any specific amount of savings on myself, but hey, I just work and try to save as much as I can every month, invest as much as I can every month, but not at the sacrifice of the life that I have designed for myself. So ideally, I want you to get to a place that you don't look at, hey, I just want to save at least $200 a month, but I want you to really focus on changing your mindset to what can I do to save as much as possible, but still enjoy my life. It is really important that you understand that, because if you spend all your life trying to budget and keep it so tight, or you spend majority of the time just, how can I save money? How can I save money? And you don't actually have that enjoyment piece in front of it, your behavior and program will not sustain for the long term. And it's not the fact that I want you to save. I do want you to save, and I do want that to be a huge priority. But I also want you to have a great priority where you look at, hey, I want to get up and do something nice for my family members. Hey, I want to get up and make it to a baby shower across the states for a girlfriend or my best friend, or things of that nature. I want to send them a gift, or I want to travel to this location, or I want to start this business, or I want to help somebody else start this business. Whatever the case may be that you want to do in your present, not sacrificing that, but it's still enjoying those aspects and setting comfortable boundaries in that aspect and limits so that you're able to save as much as possible. And a lot of that comes from, yes, getting out of debt, but keeping a high intense focus on what your skills are and how you can leverage and make more income throughout your life and in your current life, and having a plan for that. So I hope this helps put a little bit more framework of why I say, hey, you need to save. But when you look at $1 million nest egg, really understand, hey, that's about $40,000. So yeah, what kind of life do I want to live? Is it $1 million, $40,000, $2 million, $80,000, $3 million, $120,000 a year? Whatever the case may be. And then the good part about this is, yeah, the 4% is just a withdrawal rate. I'm sorry, it's a little chilly here. It's just a withdrawal rate. But you can also look at those years where you do really well, you can maybe invest a little more. But the 4% accounts for the inflation that money will be charged and the rising price of money over years to come. I hope this information is helpful for you, because it's really great for you to start understanding, okay, I'm putting this money away, but you need to understand why you're putting this money away and what that process actually looks like when you get into retirement. I will tell you, you hear a lot about, and me speak a lot about millionaires and how they have a 1.2 nest egg or $3 million nest egg. Well, understand the Roth IRA and the Roth 401k option is a very, very new product. So a lot of these millionaires that you're hearing, about 59% of them, most of their money is in traditional assets, meaning they're having to pay a lot of taxes. So the benefit of what we have right now is we have education and information where we can actually do the same things they did, but we're doing it in a more tax efficient manner, so our money will go further. If you like this video, go ahead and give it a thumbs up, and I can't wait to see you in the next video.